Hello everyone, welcome to JAIIB CIB Prep. In today's video, we'll discuss about unit number 24, operational aspect of loan account. In this particular video, we'll understand about interest rate on loan, we'll understand about base rate, system, MCLR, external benchmark rate, what is credit management, what is credit monitoring. We'll understand about some of the common operational terms and aspects in loan functions. We'll look into sample operating instructions and some aspects of a few common loans like education loan, vehicle loan. We'll check your progress and we'll do some practice questions. So let's begin today's session. So managing the lending business in a bank involves many day-to-day activities, and these includes deciding the interest rate for different loans, processing loan application, recovering the money lent, monitoring the loan, managing the loan portfolio, and all these tasks are part of the bank's asset related function. To manage loan properly, it's important to understand these aspects. So we'll understand them one by one. Interest rates on loan. Earlier, RBI controlled the interest rate banks could charge on loans. Later, this was deregulated, meaning banks could decide their own rates, but within certain RBI guidelines. And over time, the system for setting rates has changed. So, from benchmark prime lending rate, it moved on to base rate, from base rate to MCLR, and from MCLR, it moved on to external benchmark. And we'll understand each of them one by one. So, with respect to benchmark prime lending rate, it was used before July 2010, and after July 2010, base rate was incorporated. So, from 1st July 2010, base rate was put into the system. So, before July, banks were using benchmark prime lending rate. One of the problems with this rate, because of which base rate was introduced, is that it lacks transparency. So banks were providing low, were providing the borrowers, the prime borrowers, at loans which is lower than the market rate. So for suppose if they are offering loan at 8%, to these prime borrowers they are offering loans to 7%, and this was not acceptable to the RBI. So this system was not that transparent, so it lacks transparency, and hence RBI formed a committee headed by Shri Deepak Mohanty to review this benchmark prime lending rate. Now, this committee found that the bank offers often gave loans below this to certain customers below this benchmark prime lending rate, and it lacked transparency, and hence base rate system replaced this prime lending rate. Now the features of this base rate, let's understand the features. Just give me a minute. Says, so this base rate wasn't put in place from 1st July 2010, and it remained in the system till 31st March 2016. So all floating rate rupees loans sanctioned or renewed between 1st July 2010 and 31st March 2016 had to be linked to the base rate. So each bank could have only one base rate. And how are they calculated? So base rate were based on average cost of funds, marginal cost of funds, or other reasonable and transparent methods. So if using deposit rate as the base, the chosen deposit period must have the largest share in the bank's deposit, and once finalized, the calculation method could not be changed for at least 3 years. So the calculation of the cost could use average cost, marginal cost, any other reasonable method using card rate. So the largest deposit, and once finalized, the method could not be changed for next 3 years. Now this loan exempts. There are many loans which were exempt from the base rate. But before that, let's understand about the review and the transparency. So bank had to review the base rate at least every quarter. So it has to be reviewed quarterly, and the base rate had to be made public. So why it was introduced? To bring transparency, and that's why this rate has to be made public, and no other loan except the exempted loans could be given below the base rate. Now, what are the exempted loans? So, DRI advances, the loans which are provided to weaker sections under differential rate of interest scheme. So, loans to weaker section, it is exempted. Then loans to the bank's own employees and retired employees, to the meaning to say the staff loans, loans against a customer's own deposit in the bank, loans with government interest rate subsidy, and loans where refinance is availed. So these are exempted from this base rate system. Now, how base rate was calculated? So it included interest rate on retail deposits with 1 year maturity, and it is adjusted for CASA deposits, current account, savings account deposits. Second, adjustment for the cost of keeping CRR and NSLR, which does not earn interest, a portion of bank's overhead cost, and average return on the bank's net worth. So, base rate included all these components. So, it included interest rate on retail deposit, adjustment for the cost of keeping CRR, SLR, and a portion of bank's overhead cost, along with average rate on the bank's net worth. Now, the spread in the base rate, what is the spread rule? So, the extra interest charged to existing borrowers could only be increased if the borrower's risk profile got worse, or if there was a change in the tenure premium. Now, tenure premium changes had to be uniform for all loans with the same remaining time to maturity, and it should not be specific to one borrower or one loan type. So, no discrimination or no differentiation should be there. MCLR, marginal cost of funds based lending rate. So before 2016, banks used the base rate system to decide the minimum interest rate for the loans. In December 2015, RBI changed the rules and introduced MCLR from 1st April 2016. So all new floating rates from this date onwards must be linked to marginal cost of fund based lending rate, in short MCLR. Now, who it applies to? So, it applies to scheduled commercial banks except RRBs, small finance banks, and local area banks. And it does not apply to foreign branches of Indian banks, keep that in mind. So, it is not applicable on the foreign branches. Every bank must have a clear written policy on how the bank decides interest rate for the loan. So, there are particular interest rate rules under MCLR. Okay. So there are particular interest rate rules. First being the bank policy. So every bank must have a clear policy. Secondly, floating rate loans, all floating rate loans must be linked to benchmark set by RBI. Benchmark set by RBI. So banks can give loans at fixed or floating rate, and the floating rate is linked to this benchmark. For floating rate calculation, the benchmark rate plus spread, meaning to say extra percentage based on factors of risk, is to be provided. The benchmark rate must be clearly written in the loan agreement, and fixed rate loans which are less than 3 years, they cannot be given below the benchmark rate for the similar period. Interest rate calculation is done on the month-on-month basis. Final interest amount is rounded off to the nearest rupee. Interest rate for small loans must be fair, considering bank's cost and reasonable profit. And if one bank's take over another branch, customers should not be disadvantaged. They can stay with the old bank or shift to the new one. So, customer was given the choice, and there should be no lending below the benchmark, which was the case in BPLR. So, there should be no lending below benchmark in MCLR for any loan linked to that benchmark. A bank must have a fair policy, and penalty only for reasons like repayment delay or not submitting required documents could be uh, applied. For priority sector loans, for priority sector loans up to 25,000, no penalties allowed. Now, let's understand about the components of MCLR. So, there are particularly four components. Marginal cost of fund, it is based on the cost of new borrowings and returns on bank's net worth. Then there is negative carry on CRR. So, basically it is a loss for keeping mandatory cash reserves that does not earn interest. Then operating cost is there, expenses in giving loans, including fundraising cost and tenure premium, extra charges for longer term loans, same for all borrowers with same tenure. There are multiple MCLR. It is based on tenure premium. So bank must publish at least overnight MCLR, 1 month MCLR, 3 month MCLR, 6 month MCLR, and 1 year MCLR. So they may also publish longer maturity MCLRs. So at least these five need to be published. And there is a monthly review. MCLR for all maturities must be reviewed and published monthly on a fixed date. Now, the spread over MCLR include business strategy spread and credit risk premium. So, the spread includes business strategy spread and credit risk premium. So, business strategy spread, it is based on market competition, liquidity, product features, and credit risk premium is based on borrower's credit rating, relationship, collateral, etc. If there is a change in spread for existing customers, spread can only be increased if credit risk goes down, meaning to say credit risk worsens. So basically, if their credit score goes down, so there is increase in credit risk. If there is an increase in credit risk, then there can be a change in spread. And loan agreement must mention the benchmark rate and the reset interest reset period, which should be lower than 1 year. And for specific maturity, all loans linked to MCLR must be above or equal to it. So there should be no loan below MCLR. So no lending below applicable MCLR for that tenure. Exemptions from benchmark based interest rate. So some loans are not required to follow the RBI rules on linking interest rate for to internal or external benchmark. So these are government special scheme loans. So if the government of India has created a special scheme where interest rates are fixed under the scheme, bank must follow that rate. Secondly, restructured packages. So if there is any restructured package, loans like working capital term loan, is a restructured package. So, loans like working capital term loans or funded interest term loans given as part of loan restructuring plans are exempted. Refinance schemes are exempted. So, if loans are given under government or government undertaking refinance schemes, the interest rate fixed under the scheme will apply for the portion covered by refinance. For the remaining portion not covered by refinance, normal base rate or MCLR or external benchmark rules apply. Then loans to banks' own depositors against their deposits. So loans to depositor against their own deposit or staff loans, loans to bank employees, loans given to CEO, whole-time directors, loans directly linked to market-based external benchmark, or fixed rate loans with a term of more than 3 years. They are all are exempted. Kindly note for hybrid loans, which are partly fixed and partly floating, the floating rate must follow the MCLR rules. For fixed rate loans up to 3 years, the interest rate cannot be less than marginal cost of fund, negative carry on CRR, operating cost, and tenure premium for that maturity. External benchmark, the RBI's internal study group found that MCLR2 had some issues. So it recommended linking some loans to external benchmark, and it is applicable from 1st of October 2019. So all new loans uh, which are floating in nature, be it personal or retail, and loans to MSMEs. So all loans which are personal or retail in nature, or loans to micro and small enterprises. So this was applicable in 2019 and 2020. Medium enterprises were also included. So it is basically loans to MSME. So all new floating rates, personal or retail loans and loan to MSMEs must be linked to either RBI policy repo rate, 3-month Government of India Treasury bill yield, which is published by FBIL, 6-month Government of India Treasury bill yield, or any other market interest rate, which is published by FBIL. Banks can also offer external benchmark linked loans to other borrowers, and for one loan category, a bank must use the same benchmark. So it cannot mix different benchmarks in same categories. Keep that in mind. So it is here uniform benchmark for each categories. Existing loans under MCLR base rate or BPLR will continue until repayment or renewal. If a floating rate borrower can repay without charges, they can shift to an external benchmark without any extra cost. So the new interest rate must be the same as a fresh loan of that type. Other borrowers can also switch, but only on mutually agreed terms, and the change will not be treated as closing the old loan. So keep that in mind. Now let's discuss about credit management. Credit management is how banks and financial institutions handle the entire loan process, from checking if a borrower qualifies, approving the loan, giving out the funds, and from monitoring and recovering it. So here the credit includes short-term loans and advances, medium and long-term loans, and as well as offshore off balance sheet transactions. So these off balance sheet transactions like guarantees, letter of credit, so they are also included under the expression credit, right? So off balance sheet transactions like guarantee, letter of credit, so these are also included in the expression credit. So the process includes 5 stages. First is pre-sanction appraisal, from studying the borrower's need, repayment capacity, and risk factor before approval. Then sanction official loan approval. So this is first, this is second. The third is documentation, preparing, signing legal papers, protect the bank's right. Fourth is disbursement, releasing the funds to the borrowers. And fifth, being post lending supervision. So, regularly monitoring the account to ensure repayment and detect risk. The key areas in credit management includes capital adequacy norms. So, making sure the bank has enough capital to handle its risk. Then, risk management and asset liability management. So, balancing what the bank owns and what the bank owes. So this is balance between what the bank owns and owes, right? Then we have exposure norms. limiting how much can be lent to one borrower or group. Risk-based pricing is there, charging interest based on risk and rating the borrower's creditworthiness. Asset classification, income recognition, provisioning norms, classifying loans like standard, NPAs, and deciding when to recognize income and setting aside money for bad loans. And loan review. So, loan appraisal, decision making, loan review to evaluate loan proposals and reviewing existing loans regularly. Credit exposure guidelines. So, credit exposures means total amount. So, this exposure means total amount, and it includes fund based as well as non fund based exposures. So fund based, like when this actual flow of funds from the bank, like actual loans are given, term loans, working capital loans, and then there are non fund based credits, so where the amount has not been released from the bank and it will be released when a condition will be met, so like guarantees, letter of credit. And it also include investment exposures, so investment in securities, underwriting, etc. And how are these calculated? So take whichever is higher between the sanction limit and amount outstanding. And for fully drawn term loans where no money more money can be withdrawn, only the outstanding is counted. uh, there's exposure limits to single and group borrowers and are as per RBI's large exposure norms. For single counterparty, maximum exposure can be 20% of bank's tier 1 capital. For group of connected counterparties, maximum 25% of tier 1 capital. For NBFCs, for single NBFC, excluding gold loan companies, maximum 20% of tier 1 capital. For a group of NBFCs, 25%. And for gold loan focused NBFCs, then there are separate RBI ceiling which applies. So for gold loan NBFCs, exposure can be higher as per regulatory ceilings. There are separate RBI ceilings which apply to them. Then exposure to industries and sectors. So bank can set their own internal limits for different industries like textile, tea, jute, etc. So they don't put too much money into one sector. Um, for specific category exposures, we have unhedged foreign currency exposure. So bank must have board approved policies for loans in foreign currency, and loans for export may be exempt from some hedging requirements if receivables cover them. So they must have board approved policy for USD 10 million and above. Banks must have. So this is mandatory and not optional for the banks. Real estate exposure. So banks should set board approved limits and rules for lending to real estate, including special economic zone projects. Then we have leasing, hire, purchase, and factoring. So exposure to each activity should not be more than 10% of total advances. Then we have joint ventures, wholly owned subsidies. So loan or credit allowed up to 20% of bank's capital fund, again subject to RBI's guideline. Then we have loan review mechanism. So credit audit is there. This credit audit is a systematic check to ensure loans are handled properly according to bank and RBI's rules, both before and after sanction. Now the objective is to improve loan portfolio quality, to review big loan sanction and their compliances, to check regulatory compliance, to provide independent credit risk assessment, to uh, provide independent assessments, to detect early warning signals of possible defaults, and to recommend corrective actions to improve processes and staff skill. Now, what are the functions of credit audit department? To analyze audit findings and inform relevant departments, to follow up with controlling authorities, to update top management on issues, to close reports after corrective action is taken, and to maintain record of all audited loans. Now, scope of review. So, key activities include portfolio review, loan review, and there are some action points. So with respect to portfolio review, you assess overall loan quality. Overall quality is assessed and you avoid over concentration in risky sectors. With respect to loan review, you check all large loans and a sample of smaller ones. You review new loans with 3 to 6 months of sanction. With respect to action points, you check policy and RBI compliance. You verify documents. As a bank, you assess credit risk. You check how accounts are being monitored. Identify irregularities and early warning signals. The review frequency depends on the type of risk. If it is a low risk account, then once a year. If a medium risk, every 6 months. And if the account is high risk, then every 3 months the loan should be reviewed. So reviews also examine whether policies and reporting systems are adequate and they predict the potential future risk. So review covers regulatory compliance, procedures, practice, credit risk assessment methodologies, uh, systems, exception handling, and staff credit administration. Let's talk about credit monitoring now. So, credit monitoring means regular and continuous checking of loans by the banks to make sure the borrower is doing well financially. Loan money is used only for the approved purpose. The bank's money is safe and not turning into an NPA, and all agreed terms are being followed. So it is not a one-time check, but it is a continuous exercise. So it is a continuous supervision. It is a continuous exercise for the whole loan period. Uh, let's talk about some key features. So, the supervision of the loan account. So, review the borrower's account and their business performance regularly. Again, it is a continuous process. Starts after loan sanction and continues till full repayment. You focus on the quality and you keep the loan as a standard asset under RBI's income recognition and asset classification rules, and you ensure borrowers stick to agreed terms and conditions. So, when a bank sanctions a loan, it sets covenants. Covenants means conditions to keep track of the borrower's health. So, common covenants includes stock statement. So it is detail of goods in stocks, receivables, book dates, monthly select operational data, QIS 1, quarterly information system 1, 2 quarterly information systems, half yearly statements, annual financial statements, and then there are special clauses like a negative lien. So borrower promises not to mortgage a certain property without bank's consent. So, why bank monitor loans? What are the goals? To avoid NPS, early problem detections to reduce the losses. Again, then there are no diversions to unrelated activities. You check performance versus the projections. You compare actual business uh, to what borrower promised. Then to spot early warning signals like sales dropping, stock piling up, delay in creditors' payment to avoid time and cost overruns, especially in projects, and to take timely actions to help revive the business or to recover the loans. Then there are certain parameters bank keep a close eye on, like asset transactions, stock levels, valuation of stock, performance indicators, and financial ratios. Um, so, for account transactions like our deposits and withdrawals matching the borrowers, production and sales, do actual stock matches the estimated given during the loan application? So, for valuation of stock, whether it is in line with the market practice, market price, or the cost price with the bank, like performance indicators like sales, profit, debtor days, creditor days, and for financial ratios. So, for example, maintain a minimum 1.33 for the current ratio should be greater than 1.33 except for exports or unit new units. Then the monitoring progress is there. Like earlier, the heavy focus was on physical inspection or verification, but now it is done mainly through periodic statements, use of computer generated exception reports to highlight unusual transactions, and physical stock inspection only as a supplementary check. Now, how stock analysis helps? So, high finished good stocks, it could mean slow sales or poor quality products. High raw material stock, it may indicate poor inventory management, and if there is a wrong or inconsistent data, so it could be due to deliberate hiding of facts or poor record keeping. So, regular discussions with borrowers about unusual findings will help to correct the problems early. There are certain challenges in monitoring. So, for first, let's talk about the challenges. Then, if covenants are broken, we'll talk about the event of default. So, what are the challenges? So, for big companies with a large stock spread across multiple locations, physical checks are really time consuming, and banks rely more on financial reports and ratio monitoring for such cases. Now, what if the covenant are broken? So the conditions are not met. What about the event of default? So if borrower fails to follow agreed terms, the bank can increase the interest rates, say from 10% to 12%, demand reports more frequently, or the bank can order a stock audit and can recall the loan, meaning to say ask for repayment if the violations are serious. Now let's talk about tools, monitoring tools which are used by the bank. So there are some common or regulatory tools, the primary tools. So first being you scrutinize through operations, through reports, so automated reports in the bank system detect unusual transaction. Example, say large cash withdrawals, frequent checks, frequent check returns, sudden fund transfer to unrelated parties. So, exceptional reports are generated in these cases. Then we have stock statements. So, borrowers periodically submit details of inventory. It helps to ensure that stock levels are sufficient, stocks are marketable, and they match loan security requirements. Then there are inspection and field visits. So physical inspection of borrower premises are conducted and it checks the actual stock with the reported stock, the condition of machinery, and whether the factory is operating normally. Then we have audit reports. So it can be stock audit or receivable audit. So to verify physical inventory and to check outstanding payments for the customers. So stock audit is for verifying physical inventory and receivables audit is to check outstanding payment for customers. QIS, so quarterly information statements and half yearly statements. So it covers sales, production, expenses, and profitability, and it is used for tracking performance against budget. So it is used for tracking performance against budget. Then we have annual reviews or renewal or accounts. So it is done every year to decide whether to continue the loan, to continue the loan, to change the loan limit, and to change repayment terms. Then we have additional supplementary tools like certified statements of actual cost versus projected cost. So for project loans, actual expenses are compared to the original cost estimates. Monthly cash budgets to monitor expected cash inflows and outflows. So it is used for seasonal industries. It is used for seasonal industries. Uh, Credit audit reports are uh, used for primary. So there are credit audit reports as well, which are used in primary. Then we have GST tax returns, so used to verify actual sales turnover and tax compliance. Market intelligence is there. Informal sources mainly, so like suppliers, customers, industry reports. RBI inspection reports are there. So RBI checks banks' own monitoring and points out deficiencies. Consortium minutes meeting are there. So when multiple bank finances the same borrower, they share updates and concerns. Steps in credit monitoring. So first there's early warning. There are early warning inspections. So in early warning and in identification, a loan overdue for 2 months signals risk. So bank identifies potential NPAs and they investigate. After identifying, they try to understand the cause. So whether there is a temporary liquidity issue. So example, say there's delay in customer payments, or is there any structural problem like declining sales, obsolete technology, etc. Once they understand the cause, they try to give the immediate response. So if there's temporary issues, so they give ad hoc limits like temporary loan increase, and if there is permanent issue, they work on restructuring or recovery. Then they do transaction monitoring. So they basically investigate any suspicious transaction. They investigate large cash withdrawals, if there are free checks to unrelated parties, if there's any mismatch between withdrawals and stocks. Field level monitoring is done. So there are frequent factor visits, cross checks stock statement with actual stocks. Interest and repayment tracking is there. Like interest should be collected monthly. If there is any delay, immediate follow-ups should be taken. Documents and security monitoring is done to ensure legal documents are updated and conduct legal audit. Then we try to rectify the irregularities, fix issues which are pointed by concurrent auditor, statutory auditor, credit audit. Information gathering is there to track every media coverage of borrower. You check borrower's account with other banks and exchange information consortium meetings. Preventive actions are taken. Take steps to stop downgrade of good accounts into NPAs. We do scrutiny of statements. So banks look for sales. Look, you compare actual sales with the budgeted sales. If there is any large deviation, then it calls for an investigation. If COGS, cost of goods sold, increases beyond estimates, you check for raw material cost change or inefficiencies. You compare the operating profit from the current operating profit with the previous year. And if there's a drop in profit margin, then it's a red flag. Profit before tax are scrutinized. So if there are any sudden changes, then it requires explanation. Inventory and receivables should not grow disproportionately. For statutory liabilities like PFs, dues, GST, they must be cleared. Pending dues can outrank secured loans during liquidation. So it has to make sure that all the statutory liabilities are cleared. And then any large purchases. any fixed asset investments, they require bank approval. Now let's understand about QIS returns, quarterly information systems. So for loans of 1 CR or above, 1 crore or above, QIS one statement should be submitted before quarter begins. So it forecasts sales or production, it compares liability with CMA data. For QIS 2, you compare, it is submitted 6 weeks after. This is before quarter. This is 6 weeks after quarter. So submitted 6 weeks after quarter ends, it compares actual performance versus QIS one estimates. Uh, any deviation of more than 10% must be explained, and you check for current ratio. QIS 3 should be submitted 1 month after half yearly ends, and it compares half yearly sales versus annual budget, and you check for net fund generation. Then there are annual reviews. You compare actual results with the projections. You review repayment history. You consider request for limit increase, and if there are any high risk accounts, are to be reviewed quarterly. CRILC, it is Central Repository of Information on Large Credit. It is maintained by RBI to track large exposures across banks, and the purpose is to detect over leveraging and to identify common borrowers between the bank. So it is basically to detect over leveraging. A reporting threshold is 5 CR and above. So 50 million is equivalent to 5 crore, and the reports are to be made monthly for large credit. For default, it is to be done weekly. Red flagged accounts are to be reported, and non-cooperative borrowers also should be reported. It includes SMA2 accounts and current account balances above 1 CR. CERSI, Central Registry of Securitization, Asset Reconstruction and Security Interest of India. It is government-owned database of all security interest. It prevents same property being pledged to multiple banks, and it covers securitized transactions, asset reconstructions, and mortgages. So it is established under SARFAESI, and the main purpose is to prevent multiple lending against the same asset. Common operational terms, so end use of funds. So when a bank gives a loan, it must make sure that the money is used only for the specific purpose it is approved for. This is not just good practice, it's a part of bank's duty to manage risk and follow RBI guidelines. So bank monitors fund flow by checking invoices, conducting site visits, verifying that withdrawals from cash or credit or overdraft account matches the approved purpose. Primary and collateral securities. So, primary security is the main asset linked directly to the loan. It could be the asset bought with the loan money or any asset offered for the loan. A collateral security is the extra or backup security given to the bank to reduce the risk. So, if the borrower defaults, the bank first claim the primary security, and if that's not enough, then the bank will go to the collateral security. Personal security of guarantor. So this is when a third party, the third person, promises to pay the borrower's due if borrower's default. So no asset is directly placed here. It's a personal commitment. If the borrower fails to repay, the bank can sue the guarantor in court to recover the amount. So a contract of guarantee is there, and we'll study contract of guarantee in the coming units. Fixed and floating charges. So fixed charges are created on a specific and identifiable asset like a specific machine or a building. The borrower cannot sell or dispose of the asset without the bank's written permission. Floating charges cover assets that changes frequently, like stock in trade, raw material, trade receivables, and the borrower can use, sell, or replace these assets in the ordinary course of business. So, if the borrower defaults or the bank enforces its security, the floating charge crystallizes into a fixed charge. Margin. Bank usually finances only a part of the asset's value, keeping a certain percentage as margin. So this margin is the borrower's contribution and it acts as a cushion for the bank. For example, if machine costs 10 lakh rupees, the bank keeps a 20% margin. So the bank will lend 8 lakh rupees and the borrower must arrange for the remaining 2 lakh rupees. Refinance. So sometimes bank borrows money from specialized institutions to provide loans in certain priority areas. So major refinance provider in India includes Exim Bank, NABARD, SIDBI. So this is for small industries and MSMEs, for agriculture and development loans, and for export and finance. So even if a bank takes refinance, it still bears the full risk of repayment. So refinance does not influence whether the bank approves a loan or not. Credit risk management. So credit risk is the possibility that the borrower will not pay the loan as agreed. Banks have detailed policies to identify measures and control this risk, like setting lending limits, evaluating credit history, credit exposure norms. So RBI sets limit to avoid excess lending in one borrower or group. So this prevent concentration risk. So bank may also set sectoral risk, like cap on total lending to the steel, power sector to ensure diversification. Operational process of handling loans. Receipt of loan application. The process start when a customer applies for a loan, either in bank standard form, a letter, or online. So the bank records the application in the loan application received register or in its software system, and all necessary supporting documents are collected, like ID proof, income proof, project reports, etc. Step 2 is the assessment of viability and credit worthiness. Once the application has been received, bank evaluates whether the loan proposal is sound by checking promoter's profile, industry comparison, existing loan accounts, technical feasibility, availability of inputs, security offered, financial health, credit checks, cash flow capacity, regulated restrictions, so on and so forth. Each bank has sanctioning powers at different levels depending on the amount, customer, and type of loan. So, higher value loans are often sanctioned by loan committees instead of individuals. And if approved, the bank issues a sanction letter long term, detailing the loans and the condition. Once the loan is sanctioned, it is ready for disbursement. So, borrower accepts terms and signs the required documents. The bank creates and registers its charges over borrower's assets with authorities like Registrar of Companies, SERC, RTOs, Land Record Authorities. So for company asset, it is ROC. For securities interest, it is SERC. For vehicles, it is RTO. For mortgages, it is Land Record Authority. And only after these legal formalities are completed, does the bank releases the fund. Once the funds are released, bank monitors and supervises. So inspections are there, regular visit to check funds are being used for the sanction purpose. Borrowers has not borrowed from others without the permission. No asset has been sold or bought without bank consent. There is no misuse of short-term funds, and you review the account. So you regularly analyze the sales, the production, the profit, the cash flow. If problems are spotted, banks may ask for extra security or documents. Then there are renewal of advances. So whether it's a term loan or fixed loan, so term loan does not need renewals but are reviewed for health, and working capital loans are usually sanctioned for 1 year and they require renewal. So renewals can be at the same uh, or reduce or increase limit depending on the borrower's performance. Accounting aspect of loan products. So when a bank gives a loan, it follows double entry bookkeeping. Every debit must have a matching credit. So there are the types of loan accounts include working capital, OD, and then there are other loans. For working capital, these are running accounts where the borrower can deposit and withdraw money multiple times as long as they don't go over the approved limit. The limit is based on the sanctioned amount or the drawing power. For other loans like term loan, they are disbursed uh, once or in fixed installments, so they are not running accounts, and repayment starts as per the repayment schedule. It is usually monthly EMIs. So whenever a loan is disbursed, you debit the customer's loan account because the bank is creating an asset, the amount which is owned by the borrower, and you credit another account with the same amount. The type of account credited depends on how the money is given. For example, if the loan is given in cash, then the cash account will be credited. If it is credited directly to borrower's account, then the customer's current or saving account. And if it is paid directly to the seller or service provider, then the third party or the vendor account. Also, there are special rules for term loan. If it is for purchasing goods or services, you have to pay to the supplier directly. And if it's for refinancing, then the money can go to the borrower's current account, cash credit or OD accounts. Loan repayment. So when the borrower repays the credit, you credit that loan account to reduce the outstanding balance, and you debit the account from where the repayment is made. So you debit the account from where the repayment is made. For example, the cash account if repaid in cash. If repayment comes from borrower saving or current account, you debit the deposit account. And if repayment is via check from another bank, then the clearing account is debited. There are multiple modes of repayment. For example, check, cash, electronic transfer, automatic debits are there in NECH mandates. So borrower authorizes the bank to auto debit their accounts periodically from EMIs. So why this NECH is important? So it avoids missed EMIs and saves the bank from a manual follow-up every month. Basic operating instructions. So operating staff should be aware of every step from application to recovery. So they should be aware of bank's loan policy, the type of loan product, whether it's a home loan, personal loan, business loan, um, who can apply, what is the eligibility criteria, the age limit, the income requirements, the application forms, like specific form for each loan type. What are the required documents? The ID proof, address proof, income proof. What is the loan appraisal method? What are the margin requirements? Uh, what should be the borrower's own contribution? Like what is the repayment period? What are the processing fees, interest rate? So what are the charges and rates? Legal formalities, security management, disbursement procedures, loan account maintenance, and how do we monitor follow up? What are the RBI guidelines on lending? So they should be aware of all of this. Operating manual. So every bank has a loan and advance operating manual for its staff. So it covers principle on credit, loan policy, regulatory legal framework. So RBI guidelines like Contract Act, SARFAC, Stamp Act, and why it differs from bank to bank. So because each bank has a different risk appetite, each bank offer different loan product, and each bank has its own standard document and processes. Now let's talk about sample operating instructions. So advance against goods. Let's talk about advance against good first. So the guidelines includes uh, goods which are used as securities should not be perishable. They should be easily marketable. They should have prices that are easily available in the market. Should be stable. Should be in good conditions. Uh, then They should fully belong to the borrower. Advance is usually given against hypothecation rather than pledge. So, what is pledge and what is hypothecation? So, banks take physical possession of goods in pledge. Uh, they are more secure. In hypothecation, the borrower keeps the goods. So, bank has a legal charge over them, but the goods stays with the borrower. So, banks take margin requirements. So, when lending against goods, bank don't lend 100% of the goods value. They deduct a margin to protect against price drops and risk of goods losing value. So typically, 25 to 30% of the margin is taken, and for certain commodities, as per RBI's instruction. So the drawing power is arrived at after deducting the margin. So value of stock minus margin equals to drawing power. So it is value of stock minus margin. And the safety of the loan depends on the value of the goods and how easily they can be sold. So always value goods at the lower of the cost price or market price, or invoice value or market value. So whichever is lower, you value the goods at that price. From traders, you take the invoice or the market price, whichever is lower. And for manufacturers, for raw materials, you take the cost price or invoice price, whichever is or the market price, whichever is lower. For work in progress, it is cost of manufacture. For finished good, it is cost of sales. So if borrower values stock lower than these rules, we accept the borrower's lower value. For small manufacturers where cost is hard to calculate, use the market value minus profit margin and trade discounts. We keep our daily market price register for all goods taken as securities. And if branch manager is not confident about valuation, he or she hires an expert valuer, and cost of valuation is charged to the borrower. Storage and securities. So, go down signals are there, but before that, we need to understand one more thing: marketable indicator. So, a good indicator is a stock turnover, how quickly goods are sold and replaced. You check for stock statements, you ensure all stocks items move, and not just few items which are sold in the market. Again, if there's slow movement, the risk of unsellable stock is there. And for agriculture goods, loan must be liquidated by end of season, and carrying stock to next season needs investigation. Storage and security. So you place a sign at the go down entrance, and the purpose of the sign is that you inform the public that goods belong to the bank, and you prevent others from buying them without the bank's consent. Insurance should be there. Goods must be insured against fire, burglary, riot if needed, war or emergency. So insurance, it is very important. Full market value insurance should be obtained. It is essential. Insurance policy must be in the bank name. And insurance policy should have a bank clause. If borrower already has insurance, the policy must be assigned to the bank. And in case of accident or fire, you inform the insurance company and sanctioning authority immediately, and you file the claim quickly. Now, we have some go down requirements, that the go down should be within municipal and panchayat limits, so that it is easy for inspection. It must be secure, well built, it should be leak proof, the doors should be strong, there should be no termite risk. Ownership proof should be there, if it is owned by the borrower or whether it is rented. For hypothecated stocks, borrower must submit stock statements regularly, and the statement is late, not clear borrower's check until it is submitted. As simple as that. For stock statement, it must be signed by the borrower and should be checked by the staff for quantity, value, and for the correct calculations. Abnormal purchases, if there are any, they must be investigated, and good valuation in statement must follow the valuation rules. Inspection should be monthly or quarterly as per the sanction terms. The purpose is to ensure that goods are real, in good condition, covers the loan amount. For consortium loans, the controlling branch inspects overall stock and other branches inspect stock in their location. At the time of inspection, you have to check for certain things like borrower's legal ownership, stock is as per stock statement, physical verification matches, the record, go down is safe and suitable, the signboard should be displayed, loan account is in good condition, insurance terms are followed, and stock movement is there. What is the age of good, accessibility of go down, who has the go down keys, whether the rent is paid on time, so on and so forth. So these things are to be checked. Advanced against warehouse receipts. Banks can give loans to customer by taking warehouse receipts as security, but again, some certain rules have to be followed. So the safest receipts are those which are issued by the government warehouses, central or state, doesn't matter, but they are considered as the safest receipts. So these are automatically accepted. And receipts from private warehouses are not accepted unless the bank has formally approved that private warehouse. A reason being government warehouses are regulated. Private ones may not be reliable unless they are verified. So that's why we do not take private warehouse receipts. There are RBI rules for certain goods. So some goods fall under selective control, credit control. So RBI imposes special lending conditions to prevent holding or speculation. The warehouse receipt is for such goods. The bank must follow RBI's current rule before lending. Uh, Warehouses are classified into four grades: grade 1, grade 2, grade 3, and grade 4. So grade 1 is of good quality, 2 is fair, 3 is average, and 4 is poor. So only grade 1 warehouses are allowed. So good quality warehouses which are classify goods into grade 1 goods, only for those good qualities loan is allowed. The receipt should be recently issued to avoid lending against old or possibly spoiled goods. The receipt must be in the name of borrower's name, and again, there are negotiable and non-negotiable warehouse receipts. So, negotiable warehouse receipts are those which can be transferred from one person to another, and non-negotiables can be transferred through a separate letter and only becomes valid when the warehouse is notified. So, bank does not give loans against non-negotiable receipts because the rights are not automatically transferred, and hence no advances against non-negotiable receipts. A borrower who must be the original depositor must endorse the receipt to the bank. The receipt must be describe the goods clearly. There should be detailed description. The borrower must give letter confirming that the warehouse receipt is genuine. Borrower must send a letter to the warehouse telling them the receipt is placed to the bank and the bank has a lien on the goods, and the bank itself must send a notice to the warehouse confirming the pledge and the lien over the goods. Then physical inspection should be there. So before approving the loan, the bank should physically inspect the goods which is stored in the warehouse. Sample bags are whenever available, so samples are taken. Insurance requirement is there, so government warehousing rules require goods to be insured by the warehouseman. The bank should ensure that the goods are insured for full cost price or market value, whichever is higher, and the insurance policy details are obtained and recorded in the bank books. Authorized signatures. So the bank should give the warehouse a list of specific signature of the manager and other authorized officer who can sign delivery orders and discharge warehouse receipts. Ongoing monitoring. After the first inspection, the bank should do periodic inspection of the goods in the warehouse to ensure that they are still there, the quality and the quantity has not reduced, and no damage is there. Now let's talk about certain operational aspects of a common loan products. We'll cover two loan products here: education loan and vehicle loan. So education loan, the purpose of this loan is to help poor and needy students to get basic education and to help bright students pursue higher professional or technical education both in India and abroad. So normally bank lend within their service area, and for education loan this restriction does not apply. Students can apply from anywhere. Indian Banks Association issues model guideline for these loans, but each bank can make changes as per their own policies. So I hope the purpose is clear. Now, with respect to eligibility, the student must be an Indian national. PIOs can get loans for studies in India only. So, if a person is of Indian origin, he wants to study in India, he or she can get education loan. And for students who the loan will follow FEMA rules for the PIO students, especially regulation 7C. Keep that in mind. Regulation 7C of borrowing and lending in rupees regulation and amendments for NRIs, PIOs, OCI students, co-applicant must be permanent resident of India. If parents are also NRI, PIOs, OCIs, then in that case, another co-applicant who lives in India permanently will be required. For with respect to admission, must have the student must have secured admission to a recognized higher education course in India or abroad through entrance or merit basis. So, for merit, admission to the courses should be through a fair and recognized merit process. For professional technical courses, entry should be via common entrance test. For credit worthiness, most students will do not have credit history. So bank will treat them as credit worthy. If the student has a bad credit record, the bank may apply extra conditions depending on its risk policy. Classification. So bank may group education loans into three categories: student in top rated institutions, student going studies for abroad, and students in other domestic institutions. So the terms may vary depending on the risk, reputation of the institution, and job prospects after the study. The courses covered include all the major courses from India and abroad. So professional courses, recognized graduate, postgraduate diploma courses, courses at reputed institutes, courses under government subsidy schemes, job-oriented graduation or post-graduation courses, special professional qualifications, all of them are included. Eligible expenses include college fees, library exam fees, book fees, uniform fees, caution deposit, building fund, travel, computers if it is essential for the course, insurance premium for the student borrower, and any other course related projects. So all the course related projects are more or less included. Quantum and margin. So need based financing should be there for up to 4 lakh rupees. No margin is, no margin is required for 4 to 7.5 lakhs. 5% margin is required in India and 15% in abroad. And for loans above 7.5 lakhs, the margin is decided as per bank discretion. The scholarship and assistance should be counted towards margin. Margin can be bought in each year in proportion to the disbursement. With respect to security requirements, no security is required for loan up to 4 lakh rupees. For 4 to 7.5 lakhs, third party guarantee may be waived if parents or guardians have strong financial standings, and if loan is for computer purchase, it will be hypothecated by the bank. For 7.5 lakhs and above, the collateral is at bank's discretion. Sanction and disbursement. Loan sanctions are as per bank's power, ideally by branch near the student's home. No loan application should be rejected without approval from the higher authority, and disbursement will happen in each state directly to education institution or the vendor for any equipment or books. So to the institution or the vendor. Repayment terms. So a moratorium, the repayment holiday is course period plus 1 year. Repayment in EMI is over 15 years. So excluding study plus moratoriums, this 15 years is counted. In some cases, repayment can start small and increase over the time. Insurance. So bank may require a life insurance, credit life or personal accident policy for the student. Bank should regularly get progress report from the college or university. For foreign students, social security number details, Aadhaar, employment updates must be recorded. Aadhaar number should be noted once available. Student must submit job details after completing the course. No processing fees or upfront fees for is required for loans up to 7.5 lakh rupees, and for loans above 7.5 lakhs, the bank can decide. Capacity certificate, capability certificate. So basically, bank can issue financial capability certificate for students going abroad, because some universities require proof that sponsors can cover cost until the course is completed. Now let's talk about vehicle loans. So vehicle loan is money a bank gives to buy a new or used car, which can be repaid in monthly installments. So you can take loans to buy a new car or a used car, doesn't matter. SUVs, MUVs, two wheelers, not for commercial vehicles like trucks or buses in this case. These are non-commercial. Keep that in mind. So who can apply? So business people, traders, professionals, firm, companies, individuals, or they can apply. But the applicant age must be less than 65 years. So maximum age is 65 years. Certain documents are required, like last 3 years financial statement, last 3 years ITR, vehicle quotation or invoice, salary slips for last 3 months, bank statement for last 1 year, or KYC documents. Loan tenure is maximum up to 7 years or 84 months. Loan amount, so basically loan to value ratio is there. If the vehicle price is less than 10 lakh rupees, then 85% of the on-road price can be given. And if the vehicle price is more than 10 lakh rupees, then 80% of the on-road price is provided. Interest rate is decided by the bank, and with for interest calculation, interest is charged daily on the reduced loan balance, but again it is collected monthly. With respect to security, it is hypothecated. So the bank creates a charge of hypothecation. For charges, uh, processing fees is charged upfront. Again, no penalty for prepayment charges are there. For disbursement, banks give the loan amount directly to the dealer by RTGS or NEFT after all the legal requirements are met, and any government taxes or charges are paid. So, if there are defaults, so bank will remind the borrower multiple times via letter, call, SMS, email, or through recovery agents. If all details and documents are correct, bank must approve the loan within the stipulated time. RBI's guideline on recovery agents. So what happens is banks sometimes hire outside agents to collect money from borrowers who had not paid back their loans. So RBI has set clear rules to make sure that this is done in safe, legal, and respectful manner. So due diligence is there. Basically, before hiring recovery agents, banks must do a proper check on their past records. And when a case goes to a recovery agent, the bank must tell the borrower that the recovery agent uh, has been assigned, and the recovery agent must carry a copy of bank notice, an authorization letter from the bank, and ID card from the bank or the agency. Uh, then the details in the notice are provided. The letter must have the recovery agent's contact number, all phone numbers, public list agencies, So basically, the bank's website must have up to the date details of all the recovery agents. The pending complaints, if a borrower has complained about something, the bank should not hand over the case to recovery agent until the complaint is resolved. There should be a grievance system. So, bank must have a proper system for borrowers to complain about recovery agents. There should be no unlawful practice. This there should be ethical conduct. We need to say no unlawful practice. So contracts should clearly say that the recovery agents cannot use abusive, unlawful, or questionable methods. Training should be provided to the recovery agents. The calling hours should not be before 8 a.m. and should not be after 7 p.m. They should respect borrowers' privacy. They should handle customers politely. All recovery agents must pass IABF recovery debt recovery certificate course. Banks should regularly check if their recovery process is working well and should improve it. Even if the work is given to an agent, the bank is still responsible for the agent's actions. So there should be no harassment. There should be no threatening calls, no public humiliation, no contacting family or friends to embarrass or sending bad messages uh, or repeated calls at odd hours. Fair practice code. So this is about how the bank should handle the loan request right from the start. For all loans, whether big or small, forms should cover every detail so borrowers know exactly what is required. So there should be comprehensive forms. Uh, the disclosure of charges should be transparent. What is the processing fees, whether any part of the fees is refundable or not, if there is any penalty, what are the prepayment rules. So everything should be there, and the information must be given in writing to the borrower and should be displayed on the bank's website. And when a borrower submits the application, the bank should give a receipt or the acknowledgement. Bank should define clear timelines for approving or rejecting the loan. These timelines must be public on the bank's website, in brochures, on notice boards, and this avoids unnecessary delays. If document details are missing, the bank must inform the borrower immediately for keeping the files ready. And if a loan is rejected, the bank must write to the borrower about the reasons for rejection and the main reason within that given timeline. Loan appraisal and terms. So this is about checking the borrower's ability to repay and finalizing the terms. So proper credit assessment should be there. You should not depend on the collateral. You should check the borrower's actual repayment ability. When the bank approves the loan, it should send an approval letter with all the terms and conditions. All terms decided between the borrower and the bank must be in writing. An authorized bank official must certify them. Loan agreement copy should be there. So the borrower must get a copy of the signed loan agreement and all reference documents. Discretionary facilities. So the bank has certain powers. These should be clearly mentioned in the agreement. Also mention that the bank may not increase credit limits without a review. Where several banks lend together, they should finalize appraisal and communicate decisions quickly. With respect to loan disbursement and changes, so once the loan is sanctioned, disburse funds quickly as per the agreement. If interest rates, fees, or other condition changes, the borrower must inform beforehand, and changes apply only to the future payments. Post disbursement supervision. So for small loans up to 2 lakh rupees, bank should be helpful if borrower face genuine problems. If the bank wants the borrower to repay early or provide more security, it must give reasonable notices. Once the loan is repaid, all pledged asset must be returned promptly. If the bank has another legal claim, it must inform the borrower with full details beforehand before holding back the securities. And then there are certain general principles like banks should not interfere in the borrower's personal or business matter except where allowed by the loan agreement. There should be no discrimination, no biasness based on caste, religion, gender, etc. And bank can still participate in schemes meant for a weaker section. There should be no harassment for recovery, no repeated calls at odd hours, no abusive language, no use of physical force. And if a borrower or another bank asks for a transfer of the loan, the current bank must respond within 21 days, and the bank must have a system to resolve disputes. Complaints should be reviewed at a higher authority than the one who has made the original decision. Now let's check your progress. So who determines MCLR? It is the banks themselves who determines MCLR. So C is the correct answer. RBI has not prescribed prudential ceilings for exposure of banks to NBFCs, real estate, capital market. For all of them, RBI has prescribed. For vehicle loans, RBI is not prescribed. So A is the correct answer. Frequency of loan review depends on the risk level of the account. So D is the correct answer. If loan covenants are not observed by the borrower, it is called an event of default. So B is the correct answer. For education loan of 3 lakhs, the margin amount required is nil. For 4 lakhs, you don't require a margin. So for 3 lakhs, you don't require a margin. Now let's do some practice question. Which of the following statement regarding the base rate system introduced by RBI are correct? The base rate system replaced benchmark prime lending rate system from July 1st, 2010. The statement is correct. Banks were allowed to have multiple base rates to price loan for different borrower categories. This is not correct. The base rate methodology could be reviewed by bank anytime within a year. So it is fixed for 3 years. So this is not correct. All rupee loans sanctioned between 1st July 2010 and March 31st, 2016 were to be priced with reference to base rate. So this is correct. Loans to bank employees, depositors against their own deposit DRA advances were exempted from the base rate pricing. This is also correct. Banks should calculate the cost of funds using any reasonable and transparent methodology, including average or marginal cost. So this is also correct. And statement 7, the base rate has to be in public and reviewed at least quarterly is also correct. So 1 is correct, 4 is correct, 5 correct, 6 correct, and 7 correct. 1, 4, 5, 6, 7. So A is the correct answer for this question. Let's move on to next question. Which of the following statement regarding interest rate norms under RBI MCLR based framework are correct? MCLR applies to all floating rates sanctioned and renewed after 1st April 2016. So this is correct. Banks are prohibited from offering any fixed interest rate loans under MCLR guidelines. So no, banks are not prohibited from offering fixed interest rate loans. So this is not correct. Interest on all advances must be charged at monthly rest. So this is correct. The reference benchmark rate must be clearly mentioned in the loan contract. Yes, it should be there. So this is correct. Bank can charge penal interest even on priority sector loans up to 25,000. No, banks cannot charge penal interest for priority sector loans up to 25,000. So that's why this statement is not correct. Interest charge on small value personal loans must be justifiable based on cost and reasonable return. So this is correct. So 1 is correct, 3 is correct, 4 is correct, and 6 is correct. 1, 3, 4, and 6. So statement option C is the correct answer for this question. Which of the following statement regarding MCLR are correct? MCLR is composed of marginal cost of fund, negative carry of CLR, operating cost, and tenor premium. So this is correct. Bank must publish only one MCLR. No, it must publish at least 5. MCLR must be reviewed and published by banks on a pre-announced monthly date. This is correct. The spread charged to the borrower can be increased arbitrarily by the bank. No, this is not correct. The actual lending rate under MCLR is determined by adding applicable spread to the respective tenures. This is correct. Fixed rate loans with a tenure above 3 years are exempt from MCLR. guidelines. So this is also correct. So 1 is correct, 3 is correct, 5 and 6 is correct, 1, 3, 5 and 6. Option A is the correct answer for this question. Which of the following statements related to credit management and exposure norms are correct? Credit management includes pre-sanction appraisals, sanction document disbursement, and post-lending supervision. So all five steps are there. So this is correct. Exposure limits are determined solely based on the sanction limit regardless of actual outstanding. No, this is not correct. Risk pricing policy and credit risk rating are important components of credit management. Yes, they are important components. So this is correct. Credit exposure include only fund limits. No, it includes fund plus non-fund limits. So in case of fully drawn term loans, the outstanding amount is considered for exposure. Yes. A bank's exposure to group of connected counterparties must not exceed 30%. It is actually 25%, not 30. So this is not correct. For single NBFCs, it is capped at 20%. So this is correct. 1, 3, 5, and 7. 1, 3, 5, and 7. Option B. Option B is the correct answer for this question. Which of the following statements about loan review mechanism and credit audit is or are not correct? The primary objective of credit audit is to improve the quality of credit portfolio and review the compliance status of large loans. So this is correct. Credit audit focuses only on individual loans account and does not review the overall credit portfolio of the bank. No, this is not correct. So this is an incorrect statement. One of the key functions of the credit audit department is to follow up with controlling authorities and ensure the closure of relative credit audit reports. This is correct. The frequency of credit review is fixed and does not vary on the risk level. So this is not correct. It depends on the risk level, right? A credit audit aims to identify early warning signals and suggest remedial measures to improve credit quality and administration. So this is correct. So 1, 3, and 5, 1, 3, and 5, option A. So this is asking for non-correct statement. So 1, 3, and 5 are correct. 2 and 4 are not correct. Option C, only statement 2 and 4. So which of the following statements about credit monitoring are correct? Credit monitoring involves only the one-time inspection of the borrower's assets. So no, it is continuous inspection, not one time. So this is not correct. Objective of credit monitoring is to ensure that the borrower adheres to the regulatory IRAC guidelines. So this is correct. Credit monitoring helps in detecting early warning signals and symptoms of incident sickness in financial unit. This is correct. Borrowers with strong financial and accident credit ratings never require monitoring. So no, this is not correct. MSOD, QIS, and half-yearly statement are tools used for monitoring large credit. Correct. Credit monitoring helps in ensuring that funds are used for sanction purpose. Correct. Credit administration team is responsible for ensuring the speed of documentation and timely release of loan limits. So this is incorrect because credit administration uh, handles documentation, so it is not primarily responsible for speed of documentation, although it handles documentation. So the speed of documentation is not handled by credit administration team. Hence, this is not correct. So 2, 3, 5, and 6 are correct. 2, 3, 5, and 6. Option B is the correct answer for this question. Which of the following statement is correct regarding the scrutiny of operating system and QIS returns under Chore Committee's recommendation? The scrutiny of quarterly and half-yearly statement focuses on analyzing sales, cost of goods sold, operating profits, statutory liabilities, ensuring that they conform to the estimated budgets and covenants agreed upon between the banker and the borrower. So this is correct. In case of significant positive variance in the cost of goods sold, it is only necessary to address the issue through an increase in the selling price without considering measures to contain the rising cost. So this is not correct. The analysis of operating profit should include comparison of the operating profit to sales ratio across several periods including the current half year, previous half year, annual performance to identify any large variance that may require remedial action. So this is correct. The borrowers must explain any variance exceeding 10%, but the explanation must include only external market factors. No, it also includes internal operation adjustments. So this is not correct. In case of large variations in the movement of current assets and liabilities, particularly in inventory and receivables, the actual level should match the level projected at the time of credit sanction or annual credit renewal, and deviations should be scrutinized with urgency. So this is correct. Statutory liabilities, if outstanding for more than 6 months, will have precedence over even secured creditors in the event of companies winding up and must be given priority in repayment scheduling. This is correct. So 1, 3, 5, and 6. 1, 3, 5, and 6. Option D is the correct answer for this question. Which of the following statement about CRILC and CERC is correct? CRILC was created to monitor borrowers with exposure above 50 million only for fund-based uh, credit facility. So no, that is not only for fund-based. And initially it was uh, created to cover both fund-based and non-fund exposure above 10 CR. So it is 100 million. Banks must report current account balance of client whose name are in PAN master of CRLC, even if no credit facility is provided by the bank. This statement is actually correct. Bank must report current account balances of the client, even if no credit facility is provided. So this is correct. CRILC main report must be submitted by banks every week, not every month. So main report is to be submitted monthly and not weekly. So this statement is not correct. CERC is a company licensed under Companies Act, owned by 51% by the Government of India. Yes, so this is correct. A red flagged account is identified when one or more EVS or EWS suggest a possibility of fraudulent activities. Again, this is correct. So 2, 4, and 5 are correct, making option B is the correct answer for this question. Which of the following statements are correct regarding operational process of handling loans in bank? Loan application can be submitted in a standard format or as later, which is then converted into bank format. Yes, this is correct. The assessment of loan proposal is solely based on borrower's credit score and CIBIL report. No, it is not solely based on these two factors. Other factors are also considered, so this is not correct. In a centralized loan processing system, loan processing and sanctioning are performed by special teams at geographical dispersed hubs. So while centralized loan processing exists, it is not the only method used by the bank. So this is not used by all the banks. So this is not correct. Loan application must always be entered into loan application received register regardless of whether they are submitted manually or online. So yes, this is correct. Bank must inspect the borrower's business and assets to verify that the loan is being used for its intended purpose. This is correct. Loan sanctioning process does not involve scrutiny of the borrower's financial statement or collateral offered. So it does involve the scrutiny. So this is not correct. Working capital loan are typically renewed annually based on borrower's financials and bank's evaluation of the associate risk. This is correct. 1, 4, 5, and 7 are correct, making option A as the correct answer for this question. Which of the following statements about advance against goods is or are correct? Advances against goods should only be allowed against perishable goods that have a short shelf life. It should be for non-perishable. So this is not correct. Banks are not required to ensure that the proper storage and safety of goods in case of hypothecation. So banks do not have to ensure storage, but they are required to do in pledge. So banks are not required to ensure the proper storage and safety of goods in case of hypothecation. So this is correct. A margin of 25 to 30% is typically maintained when advancing against goods, depending on the nature of the goods. This is also correct. The value of goods pledged is determined solely by the invoice price. So this is not correct. The marketability of goods is judged based on the frequency of turnover and movement of goods. So this is correct. So 2, 3 and 5 are correct. 2, 3 and 5, making option B as the correct answer for this question. Okay, so why D is mentioned here? Uh, it says option 2 is incorrect because in case of hypothecation, banks do not have to ensure storage, but they do in case of pledge. So this is what is written here. Banks are not required to ensure storage and safety in case of hypothecation. So it is correct. It is not incorrect. It is correct, and the correct answer is to B. Which of the following statements is or are correct? Advances can be made against warehouse receipt issued by central and state government warehouse only. So advances can be made against these warehouses, but again, uh, private warehouses we don't accept generally. So as a matter of rule, advances can be made against warehouses receipts of government. So this is correct. Warehouse receipt issued by private agency may be accepted only if those agencies are approved by bank. So this is also correct. So in statement one, advances can be made against warehouse receipts issued by central and state government warehouses only. So this statement is somewhat partially correct and not wholly correct because this statement two is also correct. Uh, Warehouse receipt issued by private agencies may be accepted if approved. So this only word is the catch here and making this statement not correct. So the statement one is not correct. Advances can be made against food grain stock of grade 2, 3, 4. No, again only against grade 1. So this is not correct. Warehouse receipt must describe the stock in both words and figures. This is correct. A letter from borrower confirming the authenticity of the warehouse receipt is not necessary. It is actually required. So this statement is not correct. A warehouse receipt may be negotiable or non-negotiable, and this will be clearly marked on it. Yes, a warehouse receipt can be negotiable, non-negotiable. Uh, but bank will give loan only against negotiable warehouse receipts. Keep that in mind. The branch must serve a notice to the warehouse corporation regarding the pledge of the warehouse receipt to the bank. So this is also correct. So statement 2 is correct, 4 is correct, 6 and 7 is correct. 2, 4, 6 and 7. So here 1, 2, 4, 6 and 7, there is a duplicacy. So let's 2, 4, 6 and 7. So A is the correct answer for this question. Which of the following statements about education loan schemes are correct? The scheme aims to provide financial assistance for both basic and higher education. So this is correct. Service area norms need to be followed. No, service area norms need not to be followed. So this is incorrect. Students can apply for loans if they have secured admission through entrance or merit-based selection. This is correct. Banks are required to follow fixed margin requirement for all education loans regardless of the amount. So this is not correct. Margin is not fixed. The student borrower is assumed to be credit worthy even if they have no prior credit history, so this is correct. For loans above 4 lakh, a third party guarantee is always mandatory. No, it is not always mandatory. It can be waived off. So this is not correct. The repayment period for an education loan is fixed at 10 years. No, it is not fixed at 10 years. It is 15 years, excluding the moratorium and course period. So this is not correct. Scholarship and fees waiver available to the student must be considered while computing the loan. This statement is correct, and banks are prohibited from charging processing fees for loan up to 7.5. This is also correct. So 1 is correct, 3 is correct, 5 is correct, 8 and 9 is correct. So option C is the correct answer for this question. Which of the following statement about vehicle loan is or are correct based on bank's operational guidelines? The loan amount for purchasing a vehicle can be as high as the total cost of vehicle without any restriction on the maximum loan limit. So this is not correct. The maximum tenure can extend up to 7 years. So yeah, 84 months can be there depending on the bank's policy and type of vehicle purchase. This is correct. Loan is disbursed directly to borrower's account. No, this is not correct. It is given to the supplier account. The bank has the right to collect any tax imposed by the state or central authority related to vehicle purchase transaction. This is correct. KYC verification is optional. No, KYC verification is not optional. So 2 and 4 are correct. Only statement 2 and 4, making option C as the correct answer for this question. Which of the following statements is or are true according to RBI's guideline on engaging recovery agent? So banks are required to conduct a due diligence process before engaging recovery agent. This is correct. Banks should not disclose the detail of recovery agency to the borrower. When a default case is forwarded for recovery, banks should inform the borrower. So this is not correct. Recovery agents are required to ensure that the customer calls are recorded and the customer is informed about the recording. So this is true. This is correct. Recovery agents should be trained to handle customer grievances with care and sensitivity, including respecting privacy and adhering to the hours of for making calls. This is correct. Banks are allowed to forward cases to recovery agencies even if the borrower has lost complaints. So this is not correct. So 1, 3 and 4 are correct, making option A as the correct answer for this question. Which of the following statements regarding the Fair Practice Code for lenders as per RBI guidelines are correct? Banks must disclose all fees, charges, prepayment options, penalty for delayed payments, delayed repayments, conversion charges for loan product in the loan application form. So this is correct. Banks are required to give acknowledgement for the receipt of all loan application, but are not required to inform the borrower about the reason for. No, they are also required to inform about the reasons. So this is not correct. The timeline for conveying credit decisions should be disclosed by bank on their website, notice board, and product literature. So this is correct. Loan application must be processed with due diligence and margin. And security stipulation should not replace the assessment of the borrower's creditworthiness. This is also correct. Banks are not obligated to provide a copy of loan agreement. They are obligated. So this is not correct. In case of consortium arrangement, participating lenders must appraise the proposals in a timely manner, though they are not bound to inform the borrower of their decisions. So they are need to inform the borrower of their decision. So this is not correct. So 1, 3 and 4 are correct, making option D as the correct answer for this question. Thank you for watching this session. If you have any doubt, uh, don't hesitate to reach out to us on our Telegram group channel, JAIIB CIB Prep. We'll meet again. Till then, do revise your units.